Welcome to the Big Money Question Show. I'm Rachel Rickard-Strauss, Personal Finance Editor for This Is Money. Today, big question. If the UK economy is so strong, why has the sterling fallen? What's the connection between the two? We have Leila with us. She is a senior economist at the Prudential Portfolio Management Group, and she will be able to tell us the answer. Leila, thank you so much for joining us.
Thank you for inviting me.
Straight off, let me ask you, why is the sterling falling if the UK economy is as strong as the numbers suggest that it is?
Well, the currency has been acting as the main bellwether for big events and associated uncertainty surrounding those events. So sterling in the run-up to the referendum was volatile and weakened. The result of the referendum was unexpected, and markets hadn't priced in that news beforehand. So the surprise result caused sterling to fall quite sharply, and it's been considerably weaker ever since. And there are a couple of factors driving that. Mm-hmm. The first is that we don't know what's going to happen in the next few years to the UK economy, because there are a lot of unknowns out there. We don't know what sort of arrangement the UK is going to reach with the EU once it exits the European Union. And we don't know, for example, what the UK's future trading relationships are going to be, not just with the EU, but also further afield. And that uncertainty is resulting in that weaker sterling, because we just don't know what the prospects are. Another way of looking at it is that investors, because they don't know what to expect in the future, are asking for a discount when it comes to their asset purchases, and that is being expressed in a weaker currency.
Okay, so when you say that the sterling is like a bellwether for the economy, so it reflects how investors, how people feel about what's going to happen next. So people are nervous about the fallout of the vote to leave the EU, and as a result, that's why we see the sterling going all over the place, but largely down over the past couple of months. But I wonder, so we've had the Bank of England last week revised up its forecasts for economic growth for the UK economy. So immediately after the Brexit vote, it cut them to 0.8%, and then it said actually maybe it's going to be a bit better than that, and in November it revised it to 1.4%, and a couple of weeks ago, just now, it said, no, we're going to be all right, 2%, which is not bad really comparatively, 2% growth. So how can we have the two things going on at the same time? How can we have growth figures showing that the UK economy is relatively robust, and at the same time investors showing their caution about the UK economy by the fall in the value of the pound?
So I think again, another unknown is how the UK economy is going to respond in the coming months and years. And yes, the economy has held up very, very well. It was one of the strongest growing economies in the developed world last year. And that's largely because the UK consumer has been spending quite robustly. Whether that can continue, we don't know yet. There are indications that retail sales are softening. Mm-hmm. If that trend continues, then we would probably expect those to show up in the numbers for gross domestic product. And we do expect some slowdown in the coming months for one big factor. And that is inflation. So sterling weakness is raising the prices of a lot of the products that we import, and that is making, or will increasingly make, UK consumers feel a little less rich than they have in the past. And that has the potential to make them rein back some of the spending that they've been doing. And that in turn will weaken economic growth. The other thing that could cause a slowdown in economic growth is business investment. And businesses have been quite cautious in terms of investment over the past year because they don't know what to expect in the future in terms of this future relationship with the EU. And if that continues, that again will tend to rein back economic growth as well. Now, we don't know the extent of this slowdown. I think it's going to be extremely important to monitor what we would consider to be high-frequency data in the coming months. And by high-frequency data, I mean monthly data like surveys about how confident consumers are feeling, how much businesses want to invest, but also more official data like what are retail sales doing or what the manufacturing sector is doing in terms of production. And those will all give us early indications as to what is going to happen to economic growth. And the economic growth figures are released on a quarterly basis. So looking at some of those monthly indicators will give us a gauge of what's happening to the quarterly numbers.
Okay, and which way things are going. And as you say, it sounds like so much of it does come down to sentiment. If a lot of the growth that we have been seeing since the vote has been down to consumer spending, then that involves us feeling, secure in our jobs, secure in that our debts aren't going to get any higher than they already are, and that the economy will sort of stay relatively robust. Is there normally that kind of emphasis on consumers to the importance of the economic environment?
Well, for the UK economy, the consumers are a very important part of the country's growth. So if you're looking at sort of the broad GDP numbers, consumers contribute about 65% to that overall number. So that's a hefty chunk of the economy, and that's why the UK consumer is so crucial to the fortunes of the economy and economic growth. Probably what the UK needs is a more balanced economy, so one that is geared both towards consumption and investment, but also towards exports. The UK is very much geared towards the consumption side of things.
So we need to make more stuff, you're saying, essentially, to be able to export it, or export services as well?
Well, we already are very good at exporting services. The reason why it's important to have a balanced economy is that it insulates the UK from shocks. So let's say that we were very heavily export dependent and there was a shock to the global economy which caused a very pronounced fall in demand for the UK's exports. Then the UK would not be able to rely very much on internal consumption to make up that fall. Similarly, because we depend so much on consumers and their sentiment and their willingness to spend, if there is a shock internally which causes consumers to lose confidence and to start saving rather than spending, then we don't really have that export buffer that we can rely on so very much. So that's why it's important to have a balance when it comes to our dependence on the drivers of economic growth.
Okay. Can I just check that I understand? It sounds like there are almost two stories going on here. There's the story of the GDP growth, a lot of which is driven by consumers, it's driven by spending, consumption and sentiment. And then there's another story, which is sterling, which is more kind of about, is it fair to say it's more about investors, how we're seen externally and how investors feel the UK economy will perform in the longer term?
Well, I don't think you can look at it in isolation because the economy will affect the currency.
Yeah.
And the currency is also affected by market perceptions of what the economy is doing or should be doing. So yes, you have the market reaction, which is to say we don't know what's going to happen, and that's why we expect sterling to be weak. But there are also other factors that are acting to keep sterling weaker as well. And what we call those are the twin deficits. And by twin deficits, I mean the current account balance and the fiscal balance. So very simply, the current account balance is the balance of transactions that we make overseas. So in essence, the money that we earn from our exports and of goods and services, the income that we receive from the assets we hold externally, and similarly on the other side of the coin, what external or non-residents are exporting to us, and that balance makes up the current account, and that for the UK that's in deficit. So what that means is that we owe non-residents money, which means that we are reliant on those non-residents to fund the money that we owe. The other big deficit that we have is the fiscal balance. So the amount that the UK government or Treasury has to borrow in order to fund spending. So not all of it is generated from taxes. There is a bit of a shortfall that needs to be covered through borrowing. So the UK's borrowing needs are quite high on both fronts, and that makes the currency vulnerable, because if we owe a lot of money and we have to borrow to cover that, we're reliant on the markets and we're reliant on investors. And if there were to be worries about whether the UK can borrow as easily as it has done in the past, and the UK has always benefited from very, very positive market sentiment towards it, allowing it to raise that money. If that confidence were to go away, that could put further pressure on sterling.
Okay, that's really interesting. So in a way, we are reliant on a positive perception of our economy in order to be able to keep our borrowing costs lower. Because investors, if we want investors to lend us money, they're going to want a higher return if they're a little bit more nervous about the state of our economy.
So we've got low borrowing costs because partly because of Bank of England policy, also because the UK benefits from what is called a reserve currency. So in essence, that means that the UK is a safe haven. So in times of trouble, and by trouble I mean, let's say there's a shock externally or internally, investors tend to come to the UK because it's perceived as a safe place to keep their money. So the UK has the benefit of low borrowing costs, and it also has the ability to attract funding. That may not be the case necessarily in the future. So if investors or markets were to lose a bit of confidence in the UK's ability to raise that funding and attract that funding, then you would see that manifested in sterling weakness.
Okay, and just to bring it back to what we're seeing now, the falls that we've already seen in the sterling are reflecting precisely those factors, that kind of uncertainty about how we might be seen later on further down the line.
The uncertainty about how we may be seen, and also that is reflected in investors demanding our assets at a cheaper price, so at a discount in essence, and that is being expressed in a weaker currency.
Okay. Now, I'm wondering, what does any of this matter for ordinary households? Why should anyone be particularly fussed about the strength of the pound or about the strength of the economy?
Well, I think there are two big reasons. The first is because sterling is roughly about 20% weaker than it was a year and a half ago. That means that a lot of our imports are going to go up in price, and indeed they are slowly beginning to go up in price. The first port of call tends to be energy prices and food, and then it slowly filters through to prices of other goods that we import. And that will make us feel a lot less rich. So that's one of the effects of a weaker currency. The other effect is that it makes our holidays abroad much more expensive. So we may end up spending more time sort of traveling around the UK. And I think there have been indications already that there is less demand for flights abroad, partly because sterling weakness has pushed up the cost of travel.
Okay, but then I just wanted to go back to what you were saying about rebalancing the economy. There's an argument, isn't there, that a weaker sterling can actually help that rebalancing, that transition?
That's correct. So our imports become more expensive, but our exports become cheaper. Now, that doesn't always translate one for one. The UK has very high value-added exports, which tend to be slightly price inelastic, and by that I mean that sterling weakness doesn't always translate into a fall in the price of those exports. But technically, I think, yes, weaker sterling should make exports generally weaker and should promote that rebalancing of the economy.
So it's not necessarily all bad news?
No, it isn't. I think the other thing that's happened in the last few months is the FTSE 100, which is very internationally exposed. So a lot of FTSE 100 companies have a lot of high earnings in foreign currencies like the euro and the US dollar, and that weaker sterling is feeding through into higher earnings for those companies.
We should say that the FTSE 100 is just the top UK economies, the biggest ones,
Yes.
An index of those. And while they are listed here, they can be, a lot of them are miners, mining companies, so really nothing to do with necessarily the UK economy at all.
That's correct, yes.
Leila, thank you so much for explaining that, and thank you very much for joining us for the Big Money Questions.